Okay, so the next step of the accounting cycle is the adjusting entries. So you have the unadjusted trial balance and the adjusted trial balance. So from analyzing business transactions, we took that and we recorded journal entries. Then we posted the journal entries to the general ledger or the T accounts. And then from the general ledger, the T accounts, we take those numbers and put them into the unadjusted trial balance. All right, so we're going to continue with Ann's story. Ann started a facility. She invested money into a company to start a athletic facility to train athletes. All right, so her company's name is Greater Athletic Performance, or GAP. So we're going to take the numbers from the T accounts and put them into the unadjusted trial balance. And really this is to see if our basic accounting equation is in balance, that our debits equal our credits. So we have to make sure that our debits equal our credits. All right, so we're going to go through each T account and we're going to post it as either a debit or a credit. All right, so the first one, we got cash. Cash, and I want you to take note. Let me just do this here real quick. Take note that these here are your assets. I'm going to erase this so you can see everything. And here, right here is your liabilities. Right here is part of your owner's equity. Owner's equity. You see that? So we have our assets listed first, our asset accounts listed first. Then we have our liability accounts. And then we have our owner's equity accounts starting with capital, draw, revenue, and expenses listed there. I'm going to erase that so you can see numbers. So again, you have your assets listed first, your liabilities, then your owner's equity accounts. All right, so we have cash. So if we go back to the T account, our cash balance in our T account was $12,300, right? So we are in the positive with our cash account, so it is a debit. So we have $12,300 added to the debits under cash. So it's on the debit side, left side is debit, credits are always on the right. All right, our accounts receivable account. We had $2,500 that were owed to us, and they ended up paying $300. So our accounts receivable account is $2,200, our ending balance. So we're owed $2,200, right? Accounts receivable is a debit because it's an asset, right? So $2,200. Our supplies account, if we look at our T account here, we have $500 worth of supplies. So we have $500 in the debit under supplies. We have $500 there. Our furniture in our organization. Ann purchased furniture. She has $1,000 worth of furniture that's in her facility. $1,000 worth of furniture. It is a debit. It's an asset. So we have $1,000 under debits for furniture. Our equipment. Ann's equipment is worth $20,000. She had to purchase some volleyball courts, some basketball courts, some pitching machines. So her equipment's worth $20,000. And again, it's an asset, so it's listed under debits. All right, now we have our liabilities. So if we go to our liabilities, we have accounts payable. That's the only liability account we have right now. And it shows that we purchased something on account and purchased $1,500 worth of things on account. So that was the supplies and the furniture. and she paid that off. So our accounts payable account zeroed out. So we no longer owe that. So it is a credit, and it shows that we owe nothing, right? Accounts payable, we owe nothing. All right, now we go to the capital account, Ann's capital. Ann invested $35,000 of her own money into the organization. So Ann's capital shows that she has that money invested in the organization, so she lays claim to that $35,000. Now Ann's capital is a credit because capital is, in its normal form, is a credit. So we have $35,000 on the credit side. Remember, Ann decided to withdraw $400 from the organization for her own personal use. So that's Ann's drawing account. So we see $400. Now, Ann's drawing account, that is a debit. Drawing is a debit. So we have $400 under the drawing account. Now our revenue, our service revenue. Ann received $850 and $2,500 in service revenue. So the total revenue account comes up to $3,350. Now revenue is always a credit, so we have to put that on the credit side. So we have $3,350 on the credit side. Our advertising expense was $250. Now expense is always a debit, $250, and our rent expense was $1,700. All right, so we have all of our numbers taken from the T accounts and put into the unadjusted trial balance. Now I want to put this up here real quick. So we have debit, we have credit, we have assets, draw, and expenses, and we have liabilities, equity, and revenue. All right, so in their normal form, assets will always be a debit, draw will always be a debit, expenses will always be a debit. Liabilities will always be a credit, equity will always be a credit, and revenue will always be a credit. So in their normal form, they'll always be, debits will always be assets, draw, or expenses, credits will always be liabilities, equity, and revenue. All right, so that's what we have here. Now we're going to see if our accounts balance up. All right, so when we take all these numbers and add them together, now remember Ann's draw decreases Ann's drawing decreases owner's equity. All right, so always remember that drawing always decreases owner's equity. So when we add these up, we come out to a total of $38,350. So we add the $12,300, the $2,200, the $500, the $1,000, the $20,000, the $400, the $250, and the $1,700 to get $38,350. Then when we add the $35,000 that Ann has invested and the $3,350 that was Ann's revenue, so we have the revenue, the service revenue of $3,350, we get a total of $38,350. All right, so we see now that in the unadjusted trial balance, now the unadjusted trial balance will always have a date, right, at the top. We see in Ann's unadjusted trial balance that her debits equal her credits. So her debits equal her credits, so assets equal liabilities plus owner's equity, right? Assets equal liabilities plus owner's equity. So our basic accounting equation is in balance. Now again, I'm going to go through the asset accounts, debt draw accounts, and expense accounts, just so you understand what are debits and credits. All right? In their normal form, so in their positive form, assets will always be a debit. Withdrawal or drawing account will always be a debit. And expenses will always be a debit. Now, in their normal form or positive form, liabilities will always be a credit. Equity will always be a credit. And revenue will always be a credit. And you can see that in the unadjusted trial balance that our liabilities, we didn't have any liabilities, but they would be a credit if we did. Our capital is our credit, and our service revenue, our $3,350, is our credit. Debits are always on the right, debits are always on the left, credits are always on the right. All right? So that's the unadjusted trial balance. Once the unadjusted trial balance is finished, then we do the adjusting entries, and then we post to the adjusted trial balance. And we'll do that in the next lecture. All right?